everyone, and welcome to another episode of AdBits. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's episode, pre-IPO stock and your self-directed IRA. Well, 2020, 2021 were blockbuster years for unicorn company, huge valuations, SPACs, and IPOs. And the end of 2021 proved robust. However, the beginning of 2022 did not. And a lot of SPACs that went public in the 2021 taxable year have now struggled. And obviously, even some mature companies have struggled in 2022 with the Dow and the S&P 500 trending downwards. The Russia-Ukraine situation has not helped. Price of oil, inflation, all that stuff has created a kind of topsy-turvy marketplace. However, there are still lots and lots of exciting companies that could potentially go public this year, like Stripe and SpaceX and Instacart and Reddit and Impossible Foods and Discord and Plaid and House. So there is a pretty large and growing marketplace of companies that offer you the ability to buy these pre-IPO shares from employees. For example, someone who works at SpaceX and maybe has vested stock in that company and wants a little bit of liquidity. And based off their stock grant, they have the ability to sell it to a third party. There is a growing private marketplace of companies that will offer you a platform to be able to buy these shares from a third party, generally insiders, employees, people that have the stock. Since they're not publicly traded, there's no way for the general public to be able to go and get these shares. So the only way to do it is through these platforms that basically connect employees, former employees of these companies and the general public like you and me. Now, using a self-directed IRA to do that is certainly possible. What are the advantages? Number one, when you sell the shares, since generally these companies are corporations, it's a sale of property, just like selling Apple or Google stock, and there is no tax, right? There is no capital gains tax, no ordinary income tax, nothing. There's no tax. If you have a pre-tax IRA, you will end up paying tax when you take a required minimum distribution or when you take a distribution after the age of 59 and a half, which will be subject to tax. If you take a distribution prior to age 59 and a half, you'll pay tax and a 10% penalty. If you have a Roth, even better, right? So long as you're 59 and a half and the Roth's been open at least 5 years, there's no tax ever. So obviously you can see the tax advantages of getting into these pre-IPO companies like a SpaceX that you expect to multiply 15, 20, 50, 100 times in value over the next 10, 15, 20 years. Imagine being able to buy it tax-free where you don't have to worry about capital gains tax rates, whether the capital gains for gains over $1 million, $5 million, or whatever that current administration says the rate will be at the time you sell those shares, you don't have to ever worry about since it's in a Roth IRA, and it will always be tax-free so long as you can wait till 59 and a half and the Roth's been open at least 5 years. So that is obviously the huge attraction. Obviously, there's risk, right? These are private companies. There's no guarantee they're going to go public. So you potentially have some liquidity issues. There's definitely some holding periods. You can't just sell them on the public markets because the shares are not publicly traded. In some cases, you have to be an accredited investor, meaning you have to have income if you're married, filed jointly, of $300,000 for consecutive years, or a net worth of $1 million, excluding your primary residence. Something to obviously keep in mind. Now, the disadvantages, as I mentioned, liquidity and risk. The advantages is huge upside and the ability to lock in tax-free or tax-deferred gains. Marketplace is growing. It's funny, about 4 or 5 years ago, it was really just wasn't prevalent. I think this was COVID kind of hitting at the right time, valuation skyrocketing, a lot of exciting companies going public, the momentum with SPACs, and you saw a tidal wave of opportunities and lots of money being made. Now in 2022, shifted as companies, some companies that thought about going public have paused. Some companies that have elected to merge with a SPAC have paused that merger because of the turbulent stock market and some of the uncertainty and additional regulations with SPAC. So just something to keep in mind. There's no guarantee, right? Even a SpaceX or a Instacart or Impossible Foods, no guarantee they go public, no guarantee the public filing when it happens. There's no guarantee that stock does well over the next short term or even long term, right? So there is risk. It's not a get rich quick strategy. There are uncertainties, so you just need to obviously be cautious. The good news is, if you do it with an IRA or Roth, you get deferral tax-free growth. You don't have to worry about something called unrelated business taxable income, or UBIT, which is a tax imposed on IRAs that invest in active trader businesses that are operated through pass-through entities like an LLC. Why don't you have to be worried about that? Because these companies are always C Corps. Any corporation that's going to go public, or any business, I should say, that will be going public will be a corporation, whether it's Instacart, SpaceX, or Apple, or Microsoft, or Airbnb at Coinbase. They're all corp. So you don't have to worry about UBIT because the corp will box in that income, since there's corporate level tax on any corporation income, or net income, and there's no application of the UBIT tax. So just another advantage of using your retirement accounts to invest in pre-IPO stock. Obviously, you also need to do your diligence on the company, check out the valuation. Do you think the valuation is fair, it's reasonable? Is it too low, too high? Well, obviously, you probably won't have an issue if it's too low, but is it too high? For example, even Instacart, they recently cut their valuation considerably by many, many billions. So there's obviously things to keep in mind. Valuations went crazy during COVID. Now they're coming down to earth somewhat, depending on the industry. So it all depends, right? I spoke to a colleague who's in a different industry, fintech, than me, and he was getting 60 times revenues, and not even 60 times revenues as his valuation. So, just be cautious, but I think it's a very exciting opportunity. It's something that's going to get more and more, I think, prevalent and more popular. I have friends that scour LinkedIn, right? And they try to reach out to people that work at the companies they are targeting. And then they try to reach out to them and say, hey, Joe, hey, Jane, you have any stock you want to sell? So that's probably a little bit extreme, but this has been going on for many years. It's just technology has made it easier to connect these folks that want to sell their shares, and then the people like you and me that potentially want to buy it. And obviously doing it in an IRA or Roth IRA has many tax advantages, like locking in tax deferred or tax-free gain. So pretty interesting stuff. And you can check around. IRA Financial has partnerships with companies that do this. It's definitely something to take a look at if there are certain privately held companies that you think you really like and will be going public or could be going public. You may want to check out these platforms to see if you can use your IRA or 401k to invest. So hope you guys enjoyed today's episode of AdBits. I know I did. A lot of fun. I've actually dabbled in a few of these pre-IPO companies. So it's fun. You get to root for these companies. Maybe you buy their shoes, or you eat their food, or use their product. So pretty cool stuff. And you can say you got in early before the general public. So obviously there's risks, but there's also some opportunities to make some pretty good returns on your investment. So you can do it in a retirement account. Obviously, they're not going to be prohibited transactions because you're not going to own 50% or more of these large companies with probably hundreds, if not thousands, of shareholders. So pretty safe from a IRS prohibited transaction standpoint. No UBIT issues. Obviously, just do your diligence. Make sure you feel the valuation and the price you're paying is fair and reasonable, and you can kind of understand the dynamics of the transaction, including lack of liquidity and potential holding period. So there you go. Appreciate you guys listening. Subscribe if you haven't already. If you're watching on YouTube, thank you, and take care of yourself and have a great rest of your week. Talk to everyone again next week. Be well.